This is the third video in our Smart Money Concept series. In this session, after gaining an in-depth understanding of how market operators deceive retail traders through inducements or false breakouts on the chart, we'll also review a few examples directly on the charts. But before we dive in, don't forget to hit the like button to support the content and subscribe to our channel if you're joining us for the first time. We'll see you right after the intro and disclaimer. Welcome back, traders. Inducement refers to the act of encouraging others to take action by triggering their sense of greed. You can think of inducement as a form of temptation, like a hunter laying a trap by placing food in a net to lure the prey. The prey, attracted by the grains, walks into the trap, making it easier for the hunter to catch it. In this example, the grains act as the inducement. Similarly, in the stock market, operators use inducements, such as false breakouts on the chart, to lure retail traders. These traders get caught in the setup, and the operators take advantage by using the liquidity generated to execute their buy and sell positions effectively. While there are various ideas within the smart money concept, your primary focus should be on understanding liquidity and inducement, as these two elements are most frequently applied in real-world market scenarios. At this point, the price moves downward and forms a specific price action pattern on the chart. Now, a retail trader who relies solely on analyzing price action might interpret this as the market attempting to find support at the lower level. Additionally, the chart shows a double bottom formation near the support zone, followed by the creation of a strong green hammer candle. The price then surges upward sharply, breaking its previous swing high with a powerful bullish momentum candle. Based on this, it appears to be a bullish market structure, suggesting that the price could rise further after bouncing from this level. After viewing this setup, many retail traders watching this video might feel confident about entering a long position, placing their stop loss just below the hammer and the green bullish candle. From a price action perspective, there seem to be four solid reasons to go long here. However, shortly after, the price breaks below the support level and drops past the previous swing low rapidly, resulting in losses for those retail traders. If you had understood the concept of inducement from the smart money framework in this scenario, you could have avoided falling into this trap. Let's discuss how. At this point, the price breaks out of the consolidation zone and drops sharply without any retracement. This indicates that sellers currently hold more strength in the market than buyers. Additionally, the strong bearish momentum is allowing the traders who entered sell positions at higher levels to secure solid profits. As some of these sellers begin booking profits, the market slightly retraces upward for the first time. However, those who missed the chance to short earlier begin opening new short positions as soon as the price shows this small pullback, which causes the price to dip slightly once more. Since the overall market trend is bearish, it signals that major institutional players aim to push the price lower. But to drive the price below the current level, they'll need to ramp up selling pressure by entering large volume sell orders. To execute such large positions, they must first draw in retail sellers at the lower levels in equally high volume. This requires liquidity. Until retail traders observe a bullish signal on the chart, they won't enter long trades. But once a hammer candle forms, some retail participants enter long positions, placing their stop losses just beneath the support zone. At the same time, stop losses from previous retail short sellers also remain around this level. This creates a concentration of retail stop orders on both sides, acting as liquidity for smart money. However, since the nearest cluster of stop losses for a potential upward move is far above the current price, and the institutional interest lies in pushing the price downward, more liquidity is needed on the downside. To create that liquidity, the operators trigger a breakout of the swing high using a strong bullish candle, an inducement move. The speed and size of this candle excite many retail traders, who then rush to enter long positions, placing their stop losses just below this level. This surge in orders creates significant liquidity beneath, far more than what exists on the upper side. The market then takes advantage of this liquidity by sharply reversing downward. This method of enticing and trapping retail traders has become common practice across the markets today. While trading, you'll commonly encounter three main types of inducements. The first type is the support and resistance breakout inducement. This is a 5-minute time frame chart of Bank Nifty. Here, the price declines immediately after market open and then fluctuates around the psychological round number 513 for the rest of the trading session. The market bounces multiple times near this level, but no candle is able to breach it from below, indicating that this zone is acting as a strong support. The following day, after a slight gap-up opening, the price again respects this level and remains above it. However, a sharp bearish candle forms during the morning session at 11:10, decisively breaking through this support level. After the breakdown, the candle closes below the support zone, and the next candle opens beneath the previous candle's low, which leads to further downward movement. Now, seeing such a strong red candle breach a key support area, many retail participants fear missing out and rush into short positions. They place their stop losses just above the breakout zone, which creates a pool of liquidity in that region. As a result, the market sharply reverses from that area and starts moving upward. If you observe closely, before this upward move, the price consolidates within a tight range. During this phase, many buyers also enter long trades, setting their stop losses near the same support zone. But before the market rallies to hit their profit targets, a candle with a long lower wick forms, triggering the stop losses of both groups, those who went short after the breakout, and those who had gone long in the consolidation. Once both groups are forced out of their positions, the market makes a strong move upward. This is how the smart money or operators lure and trap retail traders using false breakouts around critical psychological zones such as support and resistance. Now let's analyze a bearish scenario involving a resistance level. This is a 5-minute time frame chart of Bank Nifty, where the price declines while forming recognizable price action, encountering rejection from the psychological round number zone at 513. However, shortly after, the price breaks above this resistance level with a strong green bullish candle. Observing this, many retail traders assume that a decisive resistance breakout has occurred and initiate long positions, placing their stop losses just below the broken resistance area. This influx of trades leads to an increase in liquidity in that region, prompting the market to reverse direction and move downward, sweeping up the stop losses. But why does this pattern repeat so frequently in the markets? Let's explore the underlying reason behind this behavior. In this scenario, the market initially begins to decline while forming a series of lower lows. As the price approaches the previous swing high region, some retail traders notice bearish price action and decide to open short positions, placing their stop losses around that swing high. When the price then nears a support zone, a portion of these traders book profits and exit, while others continue holding. As the price repeatedly tests this support level, new fresh short positions are initiated by additional retail traders. This leads to liquidity buildup, allowing the price to rebound upwards by utilizing the liquidity from lower levels. Once the market climbs and nears the psychological level of 51,500, buyers begin booking profits, and gradually, sellers start entering again, causing the price to pull back. On the following day, when the market opens near this same psychological level and begins to drop, the confidence among sellers increases, leading to a higher number of short entries. Their stop losses are positioned in this upper region. To draw more retail participation, after some consolidation, the market breaks this support zone, triggering an influx of short selling activity, with stop losses placed above. This surge in liquidity allows institutional traders to enter large buy orders, pushing the price up to capture that liquidity. Because the market has breached a significant psychological barrier, the positional sellers who believed price wouldn't exceed this zone begin to panic and close their positions, resulting in a short covering rally that drives the price sharply upward. Number 2. Range breakout inducement. In this setup, the market moves within a sideways range, where the price consistently tests the upper and lower boundaries of the range multiple times without any clear breakout. Traders observe these highs and lows being respected and expect the price to continue bouncing within the range. However, after some time, the price appears to break out on one side, either above the range resistance or below the support, with a sharp move. This breakout leads many retail traders to assume a genuine range breakout is underway, and they start entering trades in the direction of the breakout, placing their stop losses just outside the opposite side of the range. This surge of new positions generates a significant amount of liquidity in that breakout area. Once this liquidity is present, smart money or institutional players use it to fill their own large orders by triggering a sharp reversal, and the price moves aggressively in the opposite direction to trap the retail traders and sweep their stop losses. This is a 5-minute time frame chart of Cap Nifty, where the market opens with strong momentum candles and then consolidates within a narrow range throughout the day. Since it's the weekly options expiry day for this index, many retail traders are on edge, waiting for a breakout in either direction. Then, at 2:05 p.m., a sharp bearish candle forms, breaking down through the range, which many interpret as a genuine breakout. Excited by the possibility of a hero or zero trade, especially with option premiums being low at this time, numerous retail traders quickly jump into short positions. Most of them place their stop losses just above the broken range, creating a pocket of liquidity in that area. What happens next is classic. The market quickly reverses upward, sweeping through both the stop losses of new sellers and those of buyers who were already positioned. This fake breakout traps retail traders who fell for the inducement candle. Such traps are becoming increasingly common, where smart money uses false breakouts late in the day to exploit retail psychology. If you were trading on this day, chances are you may have been caught in this exact setup. Now, let's move on to the second type of inducement candle. 3. Trend breakout inducement. This is a 5-minute time frame chart of Nifty 50, where the price is seen trading in a bullish trend, repeatedly testing the psychological level of 25,000. This level is acting as a strong support, while there's still a minor resistance zone above, which the market has not yet breached. For retail traders observing this price action, both these levels become critical zones. A breakout in either direction appears to signal a trading opportunity. The next day, the market opens near the resistance zone but quickly drops downward. As soon as the price closes below 25,000, many retail traders jump into short positions, placing their stop losses just above the recent resistance. However, the price doesn't continue down for long. It pulls back sharply, causing panic among early sellers, many of whom exit prematurely as their stop losses are hit. Now, considering that the previous day's trend was bullish, once the price reclaims the 25,000 level, new long positions are initiated by buyers. These traders place their stop losses just below the support level. But the market again moves lower, this time sweeping the stop losses of these fresh buyers, only to quickly reverse and also hit the stop losses of earlier sellers. Because there isn't much selling pressure left above this zone, the market consolidates within this range and closes at a lower level by the end of the day. The next day, after a slight gap up, the market immediately falls sharply, breaking the previous day's low with a strong momentum candle. Seeing this, many retail traders assume that a bearish market structure is now confirmed and enter short trades at the candle's low. Their logic: the market has failed to go up for 2 days and now has finally broken key support with strong confirmation. As a result, stop losses of both previous and new sellers accumulate just above this area, creating a significant liquidity pool. To grab this liquidity, the market swiftly reverses upward, stopping out both short-term and fresh sellers. If you zoom out to a 1-hour chart, you'll notice that the market is still in a strong uptrend. This means the broader sentiment is bullish, but many traders get trapped by focusing solely on short-term, minor trends in lower time frames. This is a textbook example of how operators use trend breakout inducement to mislead retail traders and generate liquidity. In today's video, we explored how inducement traps are created in the market through fake breakouts and minor structure shifts. Right finger in the next video, we'll discuss practical strategies and psychological shifts you can use to avoid these inducement traps and trade with more confidence and clarity. Thanks for watching. I hope you found value in today's video. If you did, don't forget to hit that like button, it truly helps support the channel. And if you're new here, make sure to subscribe and turn on the notification bell so you never miss any future content. Thanks for watching, and I'll see you in the next episode.